It's great to talk to you today. Tell me a little bit about this diversification and why, and we're hearing it from lots of different sources today, why it's so important heading into 2026.
Yeah, so Contessa, you mentioned it. There's some trading, some adjusting of positions here at year end. We would look through that, look past that. We see the AI CapEx trend, the spending trend on equipment continuing to grow next year. We think that's a reliable trend, but we don't want to just play that one trend alone because, as we've seen, some of those Mag 7 stocks can get rather extended at points. So you try to look for alternative ways, subsidiary ways, if you like, ancillary ways. For example, data centers. Data centers allow you to take a position in something like in industrials or utilities, which have lower price to earnings ratios. They're not as overpriced. They're not as extended as tech stocks at their worst. So that's a good place to play the trend, we think, in a safer way. Emerging markets, also another way to play that. You're playing into South Korea, Taiwan, and places that produce a lot of the technology that's going to be used.
We've heard a lot about data centers and the opportunity there from insurers. For instance, Aon has made it a central thesis in its last earnings report heading into 2026. The analysts seem to like it. Would you look at insurers where data centers and AI are concerned?
I mean, the entire financial sector is one that we like a lot, not just insurers, but the banks as well. With the yield curve steepening here, we think that's a good time to be playing banks and the financials overall. So, yes, we would be favorable on financials.
Talk to me a little bit about what we're seeing heading into 2026 with metals. I mean, we've seen gold on a tear this year, silver as well. The precious metals in general, would you continue to keep an eye on that if you're an investor, or is it time to take the profits and run?
Yeah, you're seeing investors taking some profits here at year end. Nothing unusual about that, trying to reposition some of that money going into oil. A lot of that is speculative as people try to position for the new year. But we really think the trends that have been in place will remain in place. And so the gold trend, the precious metals trend, we think has a life to it. You just want to be a little bit careful here. We would be buying on pullbacks. For example, when gold pulled back to $3,800 to $3,900 an ounce, we were buyers then. We still like the precious metals, but we would buy on the pullbacks and not chase.
How are you feeling right now about the consumer discretionary and the staples market? What do you think of the strength of the consumer for next year?
Well, the consumer is somewhat bifurcated. You talk about a K-shaped economy where wealthier households are able to continue to spend and grow their spending, but households in the lower income quintiles, especially at the very bottom, they're not really able to. So there's going to be this divergence that's going to happen. Tariffs also are an uncertainty going into next year with the Supreme Court decision coming on those Emergency Economic Powers Act tariffs. So there's not really a lot for us to see in the consumer sectors where we see much better prospects elsewhere. We would rather take money from the consumer sectors and put that money to work in industrials, utilities, financials.
Do you think that the tax refunds do anything to change that?
The tax refunds will be important because they'll help to re-stimulate spending that we think is softening now heading into the new year and heading into the winter. That spending, that boost should help keep spending alive next year, but won't really, we think, be a real stimulus for a lot more growth. Certainly not enough to outpace or make the tech sectors look less attractive compared to consumers.
Are you putting a number yet on the S&P 500? What do you expect for next year?
Yeah, we're looking for a range at year end next year of 7,400 to 7,600 on the S&P, driven mainly by earnings. I think the main number to focus here is on the $300 earnings per share target we have on the S&P 500 for year end next year. We think it'll be a year of broadening growth in the index across the sectors, and we think it'll be a year driven mainly by earnings, not so much by prices.